Good evening, everyone. Trust you're doing well. With market seeing some healthy corrections, today we are here to throw some spotlight and share some insight on two new offerings, namely Mirae Asset BSC Select IPO Index ETF and Mirae Asset BSC Select IPO Index ETF Fund of Fund, as well as Mirae Asset BSC 200 Equal Weight ETF and Fund of Fund. To talk more about on these two offerings, we have with us Mr. Siddharth Srivastava, Head ETF Products at Mirae Asset, and Mr. Ashutosh Singh, MD and CEO at Asia Index Pvt Limited. So without wasting any time, I'll quickly ask Siddharth to jump in and first specifically give us a brief overview on both of this offering before we start diving individually on one of them. Siddharth, over to you.
Thank you, Vishal, for a quick introduction. And again, thank you, Ashutosh, for giving us your time to talk about these two new indices which BSC has developed. It's great to work with BSC again. There was some period of 3-4 years when we were actually waiting for BSC to start developing new indices. So it's great to align with a very old player who is now starting afresh in index development. So very quickly, we are coming out with two products. Both are based on newly launched BSC indices. One is Mirae Asset BSC Select IPO ETF. We are also launching the Fund of Fund based on it. And what that will do is it will pick out new listings, which implies that both IPOs as well as spin-offs, which are present in top 500 universe, which are freshly listed, will be captured in that particular offering. So for more index methodology, I'm sure Ashutosh will jump in later. So the idea here in this product is to provide a single to multiple new listings, right? Rather than the hassle of applying for each of the IPOs and waiting to get allotment. The idea is that post listing after 3 months will include new listings in our portfolio in this fund, and you get exposure to all these new listings like Zomato, Geo Financial, Swiggy, Hyundai, so on and so forth. So this is a very thematic fund which focuses on providing exposure of new listings. The second fund is different. It's a strategy product which basically provides equal weight to top 200 companies. So there will be 200 companies which will be forming part of the portfolio. Each stock will have equal weight of 0.5%. And the beauty of this product is that not only all stocks will have equal weight, because we are capturing top 100 large cap companies and top 100 mid cap companies, even the weight between mid caps and large cap will be evenly split of 50% each. And within large cap, top 50 large cap companies and bottom 50 large cap companies will again be evenly split of having a 25% each exposure. So it's a equal weight in a true sense, where all the stocks are having equal weight, large and mid cap are having equal weight, and within large cap, top 50 and remaining 50 stocks are having equal weight. So this fund basically removes stock biasness and focuses on sorts of giving exposure to each and every company forming part of this top 200 universe, which I must say is probably one of the more relevant universe, because India as a stock market has evolved so much that if I remember a few years back, MSCI India was only having 70 stocks. which used to represent the larger stocks of Indian stock market, and now it is having 146, 150 stock. So this 200 universe has become more and more relevant because it captures several industries which are not captured in large cap alone. It consists of industry leaders, it consists of capital markets, capital goods, etc. So if you want exposure of all the industries, most of the industries and most of the industry leaders, I think now it is time to look at top 200 instead of top 50 as a universe. So yeah, so these are two products which we are coming out with. Both have ETF on it. So I'll just repeat it again. It's Mirae Asset BSC Select IPO ETF and a fund of fund correspondingly, and then we have Mirae Asset BSC 200 equal weight ETF and a fund of fund correspondingly. Yeah. So these are two products which we are going to talk about. It's back to you, Vishal.
Sure. I think Siddharth will pick your brain on 200 equal weight because that's what you ended up with. So specifically when you look in the market, right, you have a lot of equal weight product that does equal weighing strategy. So first I would like you to explain to our viewer, how is an equal weight strategy different compared to a market cap weighted strategy or any other strategy that is predominantly used in the markets when you look at the index? And I think you largely covered in your summary. But again, I would
So
like you to highlight specifically why 200 universe, right? Why not just 50? Why not just 100? Why not 500? Or why not 750? So your thoughts on that?
yeah. So see, equal weight is a very popular strategy globally. Almost $330 billion of AUM in passive segment is based on equal weight strategy. In India, also, the equal weight strategy removes any biasness towards smaller stocks. It gives equal weightages, equal exposure to each and every stock. And this typically works when there's a broad market rally, right? And when there's a broader market performance. And while I believe that yes, we are seeing volatility right now, and top 10, top 15 stocks may be much more stable. But if you are looking for a 3 year, 5 year, 7 year horizon, it will be a broader market performance which I can envisage. I'll see segments like internet and e-commerce in the long run growing, your consumer discretionary segment becoming more sorts of dominant, again smaller industrial as well as manufacturing companies which are not falling, let's say in the large cap category, also growing. So you'll see more industries participating in Indian stock market, more stocks which are becoming relevant and largish from an exposure point of view, becoming more and more relevant. So I think equal weight strategy in India, for example, makes a lot of sense if you are keen on taking a broader exposure to the entire equity market. Yes, right now, let's say top 10, top 20, top 30 exposure will make a lot of sense because of current market volatility. But in the long run, I firmly believe that a broader market exposure will work, and especially this 200 universe, as I mentioned, we like a lot because it captures all large cap companies and largish mid cap companies also, or top 100 mid cap companies also, right? You have exposure to e-commerce, fintech, capital market, industrial goods, etc., which you won't find if you are only looking at, let's say, BSC 30 or Nifty 50. And then also, see, one should remember that as market grow, number of larger companies will also grow, right now S&P 500 is considered as a large cap proxy in US. So you're talking about 500 companies being defined as a large cap company, right? So in India, this demarcation of 100, 250, 500 is I think a bit of an old story. Why? In 2019, the 50th largest company, so I'm talking about 5 years back, 50th largest company का M cap was 56,000 crore, right? Right now, the 150th largest company का M cap is 65,000 crores. So 50th largest company was 56,000 crores 5 years back. This time, 150th largest company is more than that at 65,000 crores. So you are seeing more and more uh, companies get earlier. So we are seeing more and more listings which are happening, because of which there is so much space in the large cap only, right? So you have to broaden your horizons to look at more industry leaders in part of BSC also, and now Nifty 50 also. So yeah, so looking so to capture a lot of industries, and by looking at equal weight of stocks to participate, it works well when there's a broad market. I'll also talk when it doesn't work. It doesn't work when there is a very sorts of top heavy rally. Like for example, what happened in 2018. If you remember, it was only top 15 stocks which we call as Ritik stocks, and ultimately we started calling them Ritikala stocks, which performed so well. So those are the times when sorts of these broad-based strategies will not work so well, but typically in the long run, in the broad market performance, it works really well.
Yeah, I think there was some network issue, Siddharth, at your end. So just to give a summary of what Siddharth talked about briefly, 200 specifically covers your large and your larger mid caps. Predominantly, you're looking at a lot of industrial leaders being represented in that segment. And because those industrial leaders are represented, you get a equal opportunity to all of those set of stocks. Quickly here, Ashutosh, I would like to welcome you. Good evening. You guys are the brain behind the construct of the index, so I just wanted to ask you how the index is constructed, the methodology specifically, and how does it differ, let's say if somebody is looking and evaluating vis-a-vis a BSE 200 index, if you could shed some light on that.
So first up, Vishal, Siddharth, thank you so much for having me on this webinar. And like Siddharth pointed out, we are back in business. We completed our transaction buying the S&P stake last year, and since then, with the support of friends like you, we've been launching a lot of indices. So maybe I'll just take a couple of minutes to just talk about the way we construct indices, and then we can dive into specifically what we've done for 200.
Sure.
So basically, as an index provider, the way we launch indices are basically it's a two-pronged approach. One is we have a product research team that's trying to identify the white spaces in the market and trying to find opportunities that we believe have a lot of promise and where indices do not exist already. So there are many indices that we've launched like that, and then we obviously, once we've launched these indices, then we have mutual funds, we have insurance companies that come to us and express their interest in launching products. And the other is a co-creation process. And I think one of the indexes of the two that we have launched is a result of the co-creation process, where mutual funds like yourself come with an idea, they germinate the idea, and then we obviously try to flesh it out. We do a lot of back testing, we try to do some research, and we flesh out the idea through the launch of an index. So now coming specifically to 200 equal weight. The 200 equal weight is a fairly straightforward one. BSE already had an index called BSE 200, which is a free float market cap based index. And 200 equal weight, like Siddharth has already alluded to, what it in essence does, it takes the same constituent list of 200 and gives them equal weightage on every rebalance. So basically, if I could just take a step back and explain the construction of 200, so at least your audience will get a understanding of how the parent index is constructed. And then obviously we'll touch upon, what we do with 200 equal weight to bring that uniqueness. So 200, basically every index that we construct typically tends to have a parent index, right? So for the BSE 200 free float market cap based index, the parent index is BSE 500. The index, like most indices, even BSE 200 goes through reconstitutions twice a year, which for 200 happens to be June and December. On every rebalance, we, as an index provider, we look at multiple things. So some of the important variables we look at are the market cap. So basically, what we do is that so when we look at 500, what happens is the top 160 stocks in the BSE 500 automatically make it into the top 200. Then there are some buffer rules. So to reduce the churn, to reduce the transaction cost, there are buffer rules that index providers usually have in the way they construct indices. So we have a 20% buffer rule. So meaning to say that stocks, the existing stock in the index, if they are within 161 to 240, we retain them till the time we reach the count of 200. And then even after doing the retentions, we are still falling short of stocks. Then we go beyond. Then we obviously look at the ranking of the stocks as per market cap, and that's how the index gets constructed twice a year. And then obviously there is, apart from market cap, we also look at trading. We look at average annualized daily trading volumes. So that's another parameter that we consider. So in the case of 200, the annualized daily trading volume, the requirement for 200 index is 500 crores. So that is another thing we look at. And then there are some other variables like impact cost. So each constituent that is a part of 200 has to have an impact cost lower than 1%. So after they satisfy all these conditions, they become a part of the 200 index. Coming back to 200 equal weight, like I said, the parent for this one is the 200 index itself. So what we do is in June and December, every June and December, on the second Wednesday of the rebalancing months, we apply the AWO factors, which in this case will ensure that the portfolio is equally distributed, which means every stock, every constituent in the 200 will have a weightage of 0.5% on the second Wednesday of the rebalanced month, which will be June and December. And the effective rebalance, the effective rebalance for the 200 equal weight will be, in June and December, it will be the Monday following third Friday. So that is what, that is how we basically construct these two indices. And just to reinforce the point, I think what this does is basically it gives the index a 50-50 weightage between mid and large cap. But that is something that Siddharth already touched upon. So that is what it does. And when you compare this to, let's say, a 200 index to the parent index, which is purely on free float market cap, about 75% of that index will be in large cap. Whereas because of the equal weightages we are applying every 6 months, this has more like a 50-50 between large cap and mid cap. So that's on the construction of the index, Vishal.
Yeah, fair, Ashutosh. I think what I'll take from there is, we are giving an equal weightages to top 200 stock. And Siddharth, I want you to come in here and talk about specifically when you give an equal weightage to, let's say, top 10, even bottom 10 stocks, and does this help in addressing the concentration risk that generally we hear a lot, some of the indices, whether it's your most popular broad-based market indices, not only in India, even in, globally, when you talk about S&P 500, your FANGs keep dominating it. So does this equal weight strategy in a way help in address the concentration risk? If you could highlight what is the top 10 weight, let's say vis-a-vis BSE 200 or 200 equal weight, or how can that probably can get mitigated, it will be great.
Yeah, Vishal, can you first of all hear me clearly now?
Yeah, Siddharth, you're loud and clear, audible.
Okay, great. So apologies for bad connection. It always happens when there is a webinar. It doesn't happen anytime apart from that. If we are looking, so see, equal weight, the entire motive of equal weight is to remove concentration risk, right? For tech geeks or technical geeks, it is the maximum value of Harfindal index, which typically you can get, right? For example, BSC 200, it is a 200 stock index, but top 20 stocks alone has 51% weight. So top 20 stock alone has 51% weight in BSC 200. Whereas in case of equal weight, the weightage of top 20 stocks is only around 10 to 11%, right? Because of obviously mark to market की वजह से वेटेज थोड़े शिफ्ट हुए हैं. अगर रीबैलेंसिंग डेट पे देखते हैं तो 0.5 क्योंकि एक स्टॉक का वेट है, सो टॉप 20 स्टॉक का वेट 10% होता है. इट इज राइट नाउ 11.6%. Even when we are looking at top 10 stocks in BSE 200, it is around 38.9%. Whereas in case of equal weight, it is just around 5 to 6%. Now let's look at the other side. The bottom 20 stocks in BSE 200, which is a normal market cap weighted index, is around 8.4%. So bottom 20 stocks only 1.4%. So bottom 20 stock BSE 200 में उनका weight से 1.4% है. That is how narrow the tail is. But in case of equal weight, that becomes 8.4%. So the entire stock concentration risk in a way goes away. You have जो larger company होती है obviously वो छोटी जाती हैं. The smaller companies becomes relatively bigger, and ultimately each stock has equal weight or so. For example, again, a different way to put it is, like Ashutosh also said, that the weightage of large cap and mid cap companies in BSE 200 equal weight will be 50 each, right? But if you look at BSE 200, right, which you assume is a large and mid cap index, and it is a large and mid cap index, mid cap is only 18%. So even there also you are looking that your mid cap is increasing from 18 to almost 50%. So you have a more better representation. ऐसे ही if I break down, let's say, a BSE 100 or Nifty 100, you will see that top 50 stocks will roughly have around 70-80% weight, whereas the bottom 50 large cap will only have 20-30% weight. Here it is again equal. So like I mentioned, it is a very well diversified portfolio. It is equal weight in a true sense, because not only large cap, top 50, bottom 50 are equal. So it works. I think it is diversified in a true to label manner.
So I think Siddharth, what you pointed out, giving an equal weight reduces concentration risk. On that aspect, Ashutosh, I think that will also kind of give a different sectorial exposure and flavor compared to, most of the indices, those which are already there in the market, including your large caps, including your predominantly Sensex 30, Nifty 50. So in terms of a sectorial exposure, could you please, basically share some insight? How does that differ vis-a-vis, let's say, somebody who's investing into plain vanilla, just a market cap weighted large mid cap product like BSE 200 index?
Sorry, I think I was on mute. Yeah, Vishal. So I think with most of the broad market indices, they suffer from certain excesses, and that's the nature of the beast, right? Because in India, the way the economy is structured, I think financial services is obviously a very, very dominant sector. So it will always end up having a very large percentage or very large weightage in any index that is purely constructed basis free float market cap. So in this particular index, it's, let's say, if financial services is about 30% in the free float BSE 200, by virtue of actually allocating free, equal weights on the rebalance rate, the weightage for financial services comes down to 22%, 22, 23%. That's on financial services. Again, on IT, IT again is a very important sector and does constitute high percentage, high weightage in most of the other free float indices. So there again, we see that because of applying equal weights twice a year, the weightage of IT also comes down from 11% to 6%. So these are your big sectors where clearly you see the weightages being pulled back because of giving equal weightage to every constituent. So there are certain sectors which kind of are underrepresented in free float, which tend to get a better exposure here. So, for example, commodities, which is generally about 6-7%, ends up getting twice the weightage here with about 12%. Consumer discretionary, again in free float 200, will be about 13%, whereas in this one it gets about 18%. So these are such certain things that by just applying the rules of equal weight, we are seeing how the composition of sectoral mix has changed.
Yeah, I think being overweight and underweight on sectors vis-a-vis BSE 200 index can, I think, potentially lead to even the outperformance, specifically in the long run, which Siddharth talked about. So, Siddharth, I would request you to, just give us. I know past performance is not, a best predictor of the future, but even just some, the direction how because of this equal weighing strategy that resulted into being overweight and underweight on certain sector, how did the performance of the index do vis-a-vis, let's say, the comparable equal weight indices, specifically in the long run? As you already highlighted, this product is something which is to be evaluated for bare minimum 3 to 5 year framework. Over to you, Siddharth.
Yeah, so from a performance point of view, it is very important to understand that first of all, this product is digressing from your simple indices, which are market cap based indices. So there will be a performance difference typically all the time. Sometime it will be in favor of the fund, and sometime it won't be in the favor of the fund. So let's understand this nuance a bit. In the long run, right, Indian markets have grown, right? Your mid cap, small cap, smaller large cap companies, and your top mid cap companies have done relatively well, right? Think of names like Titan, etc. In the near run, yes, Zomato has corrected a bit, but so think of Zomato, think of a lot of these well-known mid-cap companies which have grown so much. So what I'm trying to say that we have seen a broad market rally, right? Where a lot of these companies have grown significantly from mid-cap space, from what we call a next 50 space, etc. And that's why you see what Vishal is projecting on the presentation right now, that in 10 years, this has given 14.5% CAGR return, and this is January 31st ending data, so a lot of corrections have been factored in. So 14.5% return versus BSE 200 giving 12.8% return, so almost 1.7% outperformance over 10 years, right? And almost outperforming Nifty by let's say shade of 2.8% CAGR again on a 10-year basis. So you see outperformance 10-year, 5-year, 7-year, even 3-year or so, whenever there is a broad market rally. And I believe that in the long run, you will see broad market performing better than, let's say, only top heavy indexes. So if Vishal, can you move to the next slide? Because what I want to show is also the cyclicality of it, right? That in years when broad market is doing well, for example, 2024, 2023, even 2021, 2021, when markets sort of recovered and there was a broad market rally, you see that equal weight did really well, and that also reflects in a long-term data. But when you look at, let's say, phases when it was only a top heavy rally, and again I was talking about top 10, 15 stocks doing well way back in 2018, 19, you see that then it has underperformed indexes like BSE, Sensex, or a Nifty 50. Even in, for example, 2013, when Nifty and Sensex did well versus the equal weight strategy. Now, in last 3 4 months, I think a lot of correction has happened, and correction has happened more in now mid and small cap space. Mid cap is almost down 19-20% from its all time high, whereas Nifty is down around 14%, 15% from its all time high. So you have seeing a significant correction. In fact, if you are looking at a stock level correction, that is more brutal. So I think if you look from a year, this year, Sensex, Nifty 50, etc. product will have a relatively better performance because probably in this also. But if you're looking from I think equal rate strategy on this longish run, whenever the markets start recovering, we see a broad market rally. That is when this strategy will perform well. So I think this is a time now, sorts of to accumulate from, and when the relief rally happen or a bull market happen again, that is when you'll probably find these funds performing better than let's say a large cap heavy portfolio.
Yeah, I think Siddharth, what you alluded was very well summarized. But because we talked about the performance on the upside, it's very important to also highlight the risk. I think you briefly touched upon it, but two aspects I specifically want you to address is the volatility, specifically in correction times, which you talked about, right? Stock level has seen some more brutal correction. Of course, your mid category has seen more, small mid cap category has seen more than the large cap, and you have a 50% large cap exposure in this fund. But still, two key aspects before we move on to the another offering. One is the volatility. What is the volatility investor can expect, specifically the short term and in the long run? And largely, what should be the investment horizon according to you for the investors who are potentially evaluating an equal weight strategy on the broad market?
So first, I'll ask question from Ashutosh because we finally managed to get hold of Ashutosh. Ashutosh, recently there have been changes in indices, and recently your rival also sorts of talked about index changes. I just wanted you to sort of explain that how index rebalancing happen, because a lot of people sort of talk about that whenever such sort of custom indices are launched, is there any involvement of AMC? We say no. I think that coming from your mouth will be that how much independent you are, how do we look at data, and how do you change the portfolio? If that you can talk about, I think that will help audience a lot.
Sure, Siddharth. So, yeah, I think as index providers, it's very important to be extremely objective in the way you define the rules. And once you've defined the rules, once they're codified, these are available in public domain, and you cannot, we generally do not do any significant changes in rules once they've been codified into the methodology document, which again is available in our case on our website, asiaindex.co.in. And these rules are like I said, initially when I was talking about the methodology, they are fairly objective. So for example, we look at market cap data, we look at the turnover data, we look at impact cost, and there are obviously some buffer rules that are predefined. So you cannot keep changing the rules on a whim. So I think these rules are pretty much, once they are there for everybody to see. And if they go through any change, they usually go through a consultation process. There are index committees that index providers have with them, and the index committees obviously they comprise members who are experts in this area. So unless these any changes in the rules that you bring about, they have to go through a formal process of index committee approvals. So yeah, I mean, and honestly, to your point of mutual funds, I think mutual funds have zero role in terms of deciding what stocks go in and what stocks go out. At best, like I said, we work with mutual funds in the co-creation process. We obviously exchange ideas before we are launching an index, but that's it. Once the index is launched, it is there in the public domain. Our rules do not change on a whim. It has to go through a very formal, elaborate process of consultations and index committee approvals. So it's a very robust process, Siddharth. So I hope that kind of assuages the concerns, if there are, of the general investor community.
Because I was listening to a lot of discussion that why Zomato came in. It's not a profit making company, whereas companies which have gone out, it's a profit making company. So we just wanted to clarify that the method is clearly written. It's all market cap based. It's all turnover and impact cost based. And if a
Just
company
allow me.
satisfy that criteria,
Sorry, so
yeah.
just allow me to come in for a minute here. So yeah, like you pointed out, I mean, again, as index providers, we have a whole bouquet of offerings, and if I were to, at a high level, classify our index offerings into different buckets. One is obviously your broad market indices, which only look at market price data of the constituents, the impact, cost, the trading turnover history, the market capitalization, so on and so forth. Then there are themes that we run. In certain themes, there could be financial data also that you're looking at. Then there are obviously strategy indices. For example, quality and value. These are two factors that come to mind where there is an overlay of financial performance too, where we look at, for example, in quality, you look at return on equity, you look at debt equity ratio. So these are things you look at in a part of or in a bucket of indexes that you have with you as an index provider. But the indices that we are discussing today, BSE 200 equal weight and select IPO, there is no overlay of any financial metrics from the balance sheet or from the P&L that we are bringing into the construction of these indices. Having said that, there could be other indices, especially value, your quality index, and there could be certain themes also that look at balance sheet and that look at P&L where there is, but those again are very clearly defined, not just defined, predefined before you launch the index. And once it is there in the in the methodology document, it's there for everybody to see, and you just cannot go and change it on a whim. So, like I said, every change, smallest of the changes, has to go through a consultation process followed by index committee approval, which is fairly elaborate in itself. So that's how it is done. So that.
Understood. So, just quickly, taking last question from Vishal regarding this offering. I think, BSC 200 equal weight, because it is diversified, is typically expected to be less volatile. See, it is very important to compare the indexes also in a rightful manner. Today, I was looking at a product where Alpha was being compared with Nifty 50, or Alpha Low Vol, which is based out of 200 space, was compared with Nifty 50, which is not right because both the indexes are completely different, right? So if you compare BSC 200 equal weight versus BSC 200, what will happen is it will depend on cycle also. When large cap is sturdy, to large cap, it will be more stable, right? But typically, stock level diversification will also help you in BST 200 equal investment horizon of what I'll suggest right now. Look at 5 years investment horizon. As I mentioned, that basically in equal weighted products, like products where we are seeing so probably in coming quickly in 3 months, 6 months, we'll see products doing well. But as I said, that this year focus on staggered investments in something like BSE 200 equal weight, and at least enter from an investment horizon of 5 years or so. So that's it on, I think, BSE 200 equal weight. Vishal, maybe we can move to select IPO.
Yeah. So quickly, I think we lost some of the voice from the Siddharth, but to quickly summarize, what he was trying to say is that largely it is a broad-based product that you have a large cap, you have a mid cap, so it should be relatively less volatile. But of course, you have a mid cap component, so it may have greater volatility, specifically in the short term, 6 month, 1 year, the volatility will be slightly higher. And as I said, you need to compare it with the right appropriate benchmark, but specifically from investment POV point of view, he talked about looking at with a 5 year plus mandate, and as he said clearly, this year you could look at BSE 200 equal weight as a year of accumulation specifically with the volatility. So keeping that in mind, we'll quickly move to another product. I think there is some internet issue. So what we'll do is. We'll ask Siddharth to switch off his camera, and then we can have a conversation where he's audible more predominantly. So quickly, I think Mirae Asset BSC Select IPO ETF as well as the fund of fund both offering the index construct itself is a very unique. I still remember Ashutosh, the co-creation process and everything. And of course, I'll ask you to jump in, weigh your thoughts on the methodology. But before that, Siddharth, just wanted to know what was the ideation, what resulted into what are the few points, parameters that you and your team looked after, evaluated, and felt okay, this is the kind of product, because this is a very unique product, right? There is no such product even on the active side. There is hardly an I think a single fund which is targeting IPO segment stock. So quickly, if you can just talk about the genesis, what led to you approaching Ashutosh for creating this index very quickly.
So I think, there are in last 2 3 years, and we believe that in coming years or so, a lot of interesting IPOs are getting listed, which is completely different to our current sectoral composition of broad market indices, right? If you look at new listings, you will find Zomato, Nykaa, Paytm. You'll find even a MNC like Hyundai getting listed, right? And then there are a lot of capital market companies which have also listed. We expect NSE to come up with an IPO in coming times. We expect a lot of new age companies also to come up IPOs in coming times. So it's a very interesting field. It's not like 10 15 years back where all your traditional companies were getting listed. Now you see more new age companies getting listed. Apart from new listings, you also have these spin-offs which are happening, right? The prominent one being Geo, right? We expect, for example, Tata Motors to hive off its EV unit. We expect more spin-off to happen in coming year. Again, these spin-off typically will focus on new age businesses more, so that company is able to sort of create its market leadership position in those important segments. So IPO as a market has evolved significantly. We are seeing largish IPOs from new age companies, even spin-off, which are resulting in creation of new age companies coming out more and more. And then also we thought that IPOs is very risky, right? First of all, a big question mark is whether you get allotment or not, and second is, do you get those listing gains or gains in next 1 2 month? So that is something which this product is not after. This product is trying to capture companies post listing, these IPOs and spin-off post listing, and try to hold it for a period of 5 years, so that we get the returns, short term to medium term returns of these new listings in the fund, and obviously the investors who have invested in this fund. So the idea was to provide a simple uh, way for an investor to get exposure in portfolio of IPOs and spin-offs and simplify it, and do it in a manner which I assume becomes more structured and more disciplined to own a new listing and to participate in these emerging newly listed companies. So the idea was obviously to basically provide exposure to this segment and provide exposure in a disciplined manner.
Yeah, I think it becomes very important then for us, to directly hear from Ashutosh, because Ashutosh, there are a lot of IPOs, specifically in the markets like 2024, we had more than 394 IPOs, more than 90 on main board. And how do you, specifically while creating this index, helped in determining, which kind of an IPO would qualify, which kind of a spin-off would qualify in the index, and which are the ones which will be left out? I think this will be, as you said, codified in your methodology. So if you can just quickly take us through in detail, step by step, what happens, let's say, a company is getting listed, then do you wait for 1 month, 3 months, and when does it get included and everything?
No, Vishal, thanks. So, before I jump into the methodology, I'll just take maybe 30 seconds to preface my response with something that Siddharth already talked about. When you guys came to us with the idea, it really got us excited because there were multiple things we were looking at. One is obviously India has been a very good IPO market. In fact, just to point out, in 2024, India was the number one market in IPOs in terms of the papers that were issued, and even in terms of the amounts mobilized, it was just behind the US. So that's how big the IPO market was in India last year, with about $20 billion getting mopped up in India in IPOs last year. And we clearly saw a lot of promise in an offering like this, because from now on, 10 years out, because obviously there'll be so many new listings, there'll be so many companies who will want to come and participate in the IPO market as the culture of capital market investing through the mutual fund route, through the secondary market directly, as that takes firmer roots. You will see clearly a lot of companies coming to the markets at maybe slightly earlier stages. And our belief is, if these trends continue, then maybe replicating what you did last year on a 10-year basis shouldn't be difficult. So we're talking about 200, $250 billion getting raised, and with obviously the markets expected to do well, we can expect $500 billion, 250 becoming 500 billion. $500 billion getting added to market cap over a next 8 to 10 year basis, just purely on the back of the good IPOs that'll come into the markets over the next few years. Now I'll take your question on the methodology. So this is maybe the only index that we have today which doesn't have a parent index. Now, what do I mean by that? While obviously there is a reference index that Select IPO has, but there's no parent, because if you look at the methodology, what we're saying is any company that that basically comes and lists itself either through the spin-off process, demerger process, or through a new listing, it has to have a history of 3 months, right? Again, this is the only index that we have which is reconstituted 4 times a year. Unlike most indices that are reconstituted, though they are rebalanced twice a year. What's the difference between rebalance and reconstitution? In rebalance, you're not basically looking at your overall portfolio, not deciding on the ins and outs. Just that what happens what happens in a rebalance is, for example, in 200 equal weight, every quarter the weights are readjusted back to 0.5. That is your 200 equal weight, where this happens every quarter. But what comes in and what goes out from the index, that happens only twice a year. So that's called reconstitution. So that's the difference between rebalance and reconstitution. This is a very unique index where the reconstitution, where basically what comes in and what goes out, that itself goes through a process where we look at the portfolio 4 times in a year, right? So that's one. That's how the index is separate. That's how the index is distinct from most of the other indices that we have in our stable. Second, like I said, it doesn't have a parent index. However, what we do is, so for example, now there's a rebalance or rebalance and reconstitution that is coming up in the month of March. So 4 times a year, that's March, June, September, December, we have a rebalance and reconstitution happening both. Uh, so what will typically happen in March, there's a reference date. So basically, we look at data of the last 3 months, that's December, January, February, and the cycle repeats every quarter, right? So for the March reconstitution and rebalance, we are looking at data of December, January, and February. So basically, all the IPOs that have got listed before 30th November will become eligible for inclusion. And why? Because we are looking at a minimum 3-month listing history. Uh, that kind of, I mean, because typically we've seen that in the first month or so, there tends to be a very high degree of volatility. There are, a lot of price fluctuations. So to basically avoid all that, we are saying that the stock has to have a minimum listing history of 3 months. So for example, when we are doing the rebalance in the month of March, all the stocks that have got listed prior to 30th November for the previous 1 year become eligible for being considered into as an inclusion into the index. Second, so once that is done, so let's say we have an IPO we've got 10 IPOs that have got listed in the period prior to November 30th. What we'll also do is for all the 10 IPOs that have got listed prior to November 30th, we will look at their average market cap in the last 3 months. So basically, November, now they have a 3-month listing history. So December, January, February, we look at the average market cap of these 10 constituents. 10 is just as an example, right? So we look at the market cap of each of these 10 constituents. They have to, if let's say the market cap is greater than the reference index, which in this case is BSE All Cap. So on 28th February, I'm also looking at BSE All Cap. I am checking these new 10 listings against BSE All Cap. If let's say any of these 10 listings is having a market cap which is greater than the 200th, so the market cap of the 200th stock, right, in ranking, we look at the reference data is of the 200th stock. If any of these 10 has a market cap greater than the 200th stock, they will directly come into the index because they've passed the market cap test in terms of being a decent size company. However, if they fail that test, then again there's another test. What we then say is, if the market cap is, so basically if the market cap is greater than the 200th stock of all cap, there's a direct inclusion in select IPO. If the market cap is between 200 and 500, so we are looking at the market cap of the 500th stock of BSE All Cap. And let's say if there are few stocks of the 10 which got listed prior to November 30, if some of the stocks have a market cap that falls between 200 and 500 of their reference index, which is BSE All Cap, then we also look at their annualized daily traded value. So then basically what we do is we rank the BSE All Cap stocks, which are like to about 1200, give or take 1200 numbers. We rank the 1200 stocks basis the market cap. We rank the 1200 stocks independently basis the traded value, annualized daily traded value. So it has to be higher than at least the 500th stock in terms of market cap, and it has to have a trading turnover which is higher than the 475th stock. So again, two things, just to simplify. If your market cap is above 200th stock in all cap, directly you're included. If you're between 200 and 500, there's another small test where we also look at your annualized daily traded value, which has to be more than the 475th stock in BSC all cap. So that's how, again, you are included. So these are some of the things that we look at. So minimum listing history of 3 months, market cap greater than 200, direct inclusion, market cap between 200, 500. You also have to pass the liquidity test or the annualized daily traded value test. So these are the things that we do for inclusion. And then obviously it has to have an impact cost which is lower than 1%. So those are the standard hygiene checks that all the index constituents go through, because some of these are mandated by SEBI as well. So these are the inclusion criteria. Now coming to the exclusion. So basically, one is obviously I've looked at what has got listed prior to 30th November, and I've checked it against my BSE All Cap in terms of market cap and also in terms of their liquidity. That is your ADTV, annualized daily traded value. So, right? So this is what I've done for including the stocks. Now, for the stocks that are already there in this list. So today there are some 51 stocks which are part of BSE Select IPO. Now each of these 51 stocks, for them, to also be retained in the index, they have to make sure that they don't drop in performance on market cap and performance on liquidity. So again, with the same reference index of BSE All Cap, if any of these existing 51 stocks in BSE Select IPO fall below the 600th stock in terms of market cap, or let's say they fall below the 600 stock in terms of the liquidity condition, which is ADTV, then they will be excluded from the index. And the other exclusion criteria is if, let's say, they have spent more than 5 years. 5 years basically is a cutoff. So these are the two exclusion criteria. So if you fail the market cap test, or if you fail the liquidity test, or if you have finished your term in the index, which is 5 years, then you will be excluded from the index. So these are the inclusion and exclusion criteria, Vishal.
Right. Thank you, Ashutosh, for giving that detailed elaboration. I think just to quickly summarize, it's like if first a company needs to get listed, you'll have a cooling period of 3 months. That is, I think, something very important because there are a lot of IPOs, there is lot of volatility. After cooling period, every quarterly you will prepare a BSE all cap list. Basically, if I can say so crudely, top 500 in terms of market cap. An IPO stock should form part of top 500 in terms of market cap. Only then it get included. Of course, there is two other ways that can get included, but broadly it has to be fallen within top 500. And once it gets included, it will get excluded if its performance drops below 600 in terms of full market cap, or it completes its 5-year life cycle. I hope I have been able to summarize it.
Yes.
Ashutosh, just one thing I just wanted, because there are a lot of questions coming in. I wanted you to clarify that whether this index considers SME IPOs. Of course, the methodology we have read, but I just wanted to hear from your mouth.
No. So, in fact, let alone the SME IPOs, it does not even consider all the IPOs that get listed on main board, because the inclusion conditions are fairly stringent, which means you are generally looking at only the quality space. So just to enumerate my point with a number. So for example, in 2023, leave aside the SME IPOs, obviously it does not consider the SME IPOs at all. And even in the main board, like I said, because of these stringent conditions on market cap, liquidity, you have only the good ones filtering through and coming into the basket. So in the year 2023, in the main board, you had about 60 IPOs, right? And in the year 2024, you had about 91 IPOs in the main board. So in 2023, of the 60, right now there are only about 10 stocks that are a part of this particular index. So not even every stock that gets listed on the main board is a part of it. Only the stocks that pass the liquidity condition, that pass the market cap condition, are the ones that filter through and become a part, come and sit in the portfolio of this particular index.
Fair. I think, Siddharth, I wanted to weigh in your opinion because I think this criteria looks slightly stringent, but I just wanted to know your opinion. Does this help relatively more compared to investing in all and in any kind of IPOs? Does this help more in providing the stability in terms of a portfolio? And secondly, I wanted you to touch upon why should investor look at this offering, right? They can directly go and subscribe to an IPO for listing in which you already talked about. But why do you think an ETF or a fund of fund to an index portfolio construct could be a more potentially prudent approach?
No,
Yeah,
sorry.
so
Before Siddharth comes in, just another quick point I wanted to make. So through this, through this very rigorous process we have. In fact, in BSE, there's another index which is based on IPOs, which is called the BSE IPO index. So there are two indexes. One is BSE IPO, and the other one is the one we're talking about, which is Select IPO. Select IPO is the one which goes through a very rigorous process of fulfilling criteria on market cap, liquidity, etc. And if you were to just compare the returns, so BSE Select IPO has a very simple rule. Any IPO that lists on the main board, so all your 90 IPOs, so you're of the 90, only about 25% will make it through. Of the 60 in 2023, only about 20% made it through. Whereas in the other one, IPO index, every constituent or every stock that gets listed on the exchange makes it as part of the index. So if I were to just compare the returns of these two, where one, I'm not doing any filtration, plus I'm including the constituent on the second day itself. right? Whereas here I'm asking the constituent to wait for 3 months, and plus there are very rigorous liquidity and market cap condition it has to pass. So when I compare this one, select IPO versus a plain IPO, where every constituent, to repeat, every constituent on the second day of listing itself comes into the index. So when I compare these two in terms of returns, on a 1 year basis, the IPO, the BSE IPO, where every constituent comes in, is about 7.4%. Select IPO has a outperformance of about 2.5% higher, which is about 9.7%. On a 3 year basis, again, your IPO, where indiscriminately you're including everything, it's 10%, and select IPO is about 13%. So there's an alpha of about 3% there on 3 year basis. And on 5 year also, there's a 1.2% kind of alpha which select IPO has over the regular IPO. So these are just some points I wanted to make before I would ask Siddharth to come and chime in now.
Thank you, Ashutosh. So, just before I jump into why we sort of curtailed our universe to only what Ashutosh just mentioned, in India since CY21, IPOs have raised more than 4 lakh crores. In 2024, you had 94 IPOs. This is on the main board. You have 58 IPOs in 2023. 40 IPOs in 2022, 63 IPOs in 2021. So you had roughly in the range of 250 IPOs in last 4 years, right? And it becomes very difficult for anyone, obviously, to time it, to choose the perfect IPO, etc. When you also look at the subscription data, right? We are looking at that in 2024, average retail subscription was 33x. For institutional buyers, it was 90x. That was the amount of oversubscription. So even if you have identified right IPOs, probably good names which are good as per valuation metrics, business metrics, etc., the chances of you getting that IPO is also on the lower side, right? And now when we look at a lot of, it's a habit which mutual funds typically do not obviously subscribe to, but if you look at the intent of subscribing to IPO, a lot of people run after listing the gains, right? Out of 596 companies which have come out with an IPO on main board since 2006, almost 180 plus or 187 to be precise had given negative returns on listing date. In fact, 15 of them have given negative return of 25% on the listing date itself. What we often miss is the journey which a lot of these IPO company takes after they have got listed, right? So we are talking about average holding period of around 4.7 years when we are presenting this data, out of which 62 companies have given 3x return, 49 companies have given 2x to 3x return, and almost 89 companies have given 1 to 2x return. So that is what sorts of we are focusing on. That and again, this data talks about some of these successful recent spin-offs and demergers which has happened in India. So I'll just yeah. So what I'm trying to say is, and this slide talks about several companies which are present in our portfolio, the returns which they have given post listing. Some of them have given great returns, some of them have underperformed, but this portfolio level approach sorts of reduces the risk which a client or an investor might be taking when he or she is investing in a single or two or three or four IPOs, right? And that is where the portfolio level approach helps. What we have done is, and like Ashutosh mentioned, that we are only focusing on top 500 companies. So we are only focusing on large cap, mid cap, and in a way small cap, right? Typically we refer 250 only as small cap, right? And post that, we are not even looking at micro caps and SMEs, because the idea is not to make this product more risky, right? Stay in a zone where you are seeing a largish IPO coming, which typically comes out with, let's say, a more robust business line, a more robust cash flows, etc. Also, what we are doing is that we are very important is that we are waiting for 3 months, since ETF cannot invest in pre-IPO phase, right? So what we are doing is, when company gets listed, you see more volatility in initial days. So we are waiting out for 3 months. Then in the next rebalancing, which Ashutosh and team are doing, we are assessing these companies. Typically what happens is, a quarterly result of a company will most likely come. So you'll see initial volatility typically die down, typically a quarterly performance of company come, and then company is considered for inclusion in the index after 3 months of listing in the next quarterly review. And we believe that is a good reasonable time for a volatility to calm down. And then when the company has come in, typically it will remain in the index for till completion of 5 years of listing. So we are capturing hopefully the good short term to medium term growth story of any new listings, including IPOs and spin-off. And as you can see, you have in the portfolio Max Health, Geo Financial, IRCTC, 197, Mindkind Pharma, IC, Piramal, Hitachi Energy, Angel One, Tata is like Happiest Mind, JSW Infra, Nuama Wealth, you have Star Health, you have Railtel Corporation, etc. And also one thing which we have done is that the weightage of stocks or addresses the risk of these IPO companies. Very quickly, since Ashutosh has talked about performance, yes, from a performance point of view, does reasonably well if you compare it against Nifty 50. But what I'll suggest is that focus on recent 5 years, because the kind of companies which are getting listed have changed dramatically in last 3, 4, 5 years, right? You have more new age companies getting listed, companies being spun off which are having more new age businesses. So in 2024, 33% versus 10%, 23, 38 versus 21%, 21, 41 versus 25%, etc. So it had good years, but then also it's an IPO centric fund, and it will have higher volatility, and it can have higher drawdown. So in 2022 this was down by 11% versus 5.7% of Nifty 50, which was positive. In 2018 you look at a 21% negative return versus 4.6% of positive return by Nifty 50. So this is a great fund if you're looking for exposure in portfolio of IPO companies, but it is definitely going to be more volatile than a typical Nifty 50 or a BSE Sensex index, and it will have a drawdown. You should only invest if you are obviously convinced with a growth story of a lot of these IPO companies and want to participate in IPOs and spin-off markets.
Yes, thank you, Siddharth. I think skimming through the presentation quickly would have helped our listeners as well as the viewers about understanding. Of course, there comes the reward, but also the volatility. I guess we'll quickly summarize. 200 equal weight is all about investing, giving an equal opportunity to each set of stocks in large and mid cap space, predominantly can be potentially part of your core portfolio, of course, with a greater investment horizon of 5 year plus. That's where Siddharth, correct me if you're This is where you are placing it. And then the IPO index is more of a tactical call where you want to include, give exposure to the growth stories of uh, IPOs that have been recently listed. But as Ashutosh pointed out, these are the companies that have made through some of the stringent criteria, right? Like from 63 companies, 92 companies IPOs done on main board, only 5-10 are getting included in the index. So these are some of the companies that have passed, let's say, some of the stringent criteria. But of course, you believe in the growth story of such companies, and such companies often, they find underrepresentation in most of your actively managed funds or your passively managed funds, and that's where you can look at. But of course, just be cognizant of the volatility, and that too should be placed with a greater investment horizon of 5 year plus. I guess that will be all. Thank you, Ashutosh and Siddharth, for sharing your valuable insight. Before we wind up, if you guys have anything, quick thoughts, quickly, just a one word, one sentence, if you want to quickly summarize, Siddharth, Ashutosh, before we take leave.
So let me go first. I just want to express my thanks to the team at Mirae because, like I said at the start, as index providers, we can create products. We can believe that some products we create are very persuasive or very compelling, but it takes asset managers like yourself to actually bring these products to life. So thanks once again, and I hope customers find merit and you have a successful NFO. Thank you so much.
Thank you, Ashutosh.
Yes. So, first of all, again, thank you to BSC team. We really like the fact that you guys are back creating these amazing indices. I think BSC 200 equal weight is a great product which can form part of even investors' core portfolio, to be honest, such as the beauty of an equal weight strategy. Though, I keep mentioning that this is a 5 year, 7 year product, that is you have to participate in a broad market rally for this product to do well. On the select IPO, I think it's a very unique product which BSC has done. I don't think in India any index provider has such a unique selection method which will only capture a largish companies. They are doing rebalancing every 3 months so that index is evolving as the IPOs are coming and as the spin-offs are coming, and we believe that we have created something which obviously is going to be volatile, is going to be risky, but will capture the IPO market and new spin-offs in a true to label manner within the top 500 space. So thank you, Ashutosh, and any investor who is listening. Yes, markets have corrected significantly. People are obviously jittery. We have looked. I think one best thing which you need to look at is if you look at number of stocks which are down by 40%, 50%, and look at indexes, the level at which indexes are down. So number of small cap stocks which are down more than 40, 50%, it will be in a significant number, but small cap index itself is down only by 24%. What I'm trying to say is that if you look at even in the large cap space, Nifty 50, Nifty 100 is down around 13, 15% or so, but the number of companies within these segments which are down by more than 30% is much larger. So index investing in a portfolio helps you mitigate those stock specific risk, stock specific drawdowns. And I think, yes, this year I'm expecting it to be volatile. I'm expecting this year to be a year of accumulation. So please invest smartly, invest from a long-term point of view, at least with an horizon of 4 to 5 years, and choose a fund which sorts of caters to your investment objective and your risk profile also. So thank you so much. It's back to Vishal.
Thank you, both of you. Before we wind up, just a quick summarizing you, all of you, that the ETF new fund offer NFO is already live. It starts today, Feb 24th. It will close on March 5th. The fund of fund option in case of both, which is BSC 200 equal weight as well as IPO, will start from tomorrow, that is Feb 25th, and will close on March 11th, 2025. So that's all from our side. In case if you guys have any questions specifically on this fund or any of the other Mirae fund, will be more than happy to answer. Please reach out to us on all our social media handles. And specifically for these two funds, you can look into our detailed presentation which we have uploaded on our website and social media handles. So thank you all. Thank you for taking out your time. Have a good day.